Hello, we are live.
Hello, everyone.
Welcome to Stake Your Wealth Live Edition.
That's right.
So in these lives, if you're new to this, we basically go into more depth on a topic that we discussed in one of our lessons. And this week's lesson was the importance of timing the market, right? Not trying to time the stock market.
The dips.
The dips,
Yeah.
right? Don't try and time the dip. And the dip, of course, is referring to when the stock market's price goes down.
Right.
And we talked about this a little bit in the last live session we had.
Yeah.
But you were asking sort of what is the market broadly? Like, what does that
Exactly.
actually refer to?
Yes.
And it's a great question, and it's worth reiterating here. The market is a sort of catch-all term for a variety of different stock exchanges throughout the world.
Yeah. And the S&P 500.
Exactly. So you have the S&P 500 in the U.S.
In the U.S., yeah.
In the U.S., you have where most of the transaction volume is concentrated. I'd actually be interested to look it up, but a large percentage, definitely the majority percentage of transaction volume takes place in the U.S. markets.
Mm-hmm. Dow Jones.
So you have the So you have the S&P 500, you have the Dow Jones,
NASDAQ.
and the NASDAQ.
Yeah.
And the NASDAQ tends to be more the technology-oriented one. The S&P 500 is the sort of top 500 performing companies, which is a little loosey-goosey. They try not to change it too often. And there was some controversy.
Once you're in, you're in.
Yeah, and it's actually a big deal.
Yeah.
Because once you get moved into the market, suddenly all these different index funds that we always talk about that you should absolutely be investing in, these broad diversified
As opposed to individual stock.
As opposed to individual stocks, yes. Once you move into them, you suddenly get tapped into all these much larger, broader institutional indices, right? And so that you get a stock pop.
Right.
So if you were a speculator and you knew that a company was about to go into the S&P 500, you would invest in that company knowing that as soon as they get pulled into the S&P 500, their stock will pop.
Right. Is that a term, stock pop?
Yeah, stock pops.
How funny.
Typically, it's used during an IPO, right?
Okay.
You get the pop after your IPO.
And only
on the day
one
of the
time,
IPO.
right? When you IPO.
And yeah, it's a one-time pop.
Okay.
But stocks can pop all the time for various reasons.
Okay, right.
But the reason I brought that example up was that Tesla. So Tesla has now reached a size that it's bigger than a lot of the other major car companies combined, right? So this is a large, by market cap, it's a large company. And so everyone was assuming, okay, it's big enough. It's certainly much bigger than some of the other components, other companies in the S&P 500. It's going to get moved in there.
Right.
And so everyone started investing in Tesla for that reason, because it's about to move in and then it'll go
stock
up even further.
pop,
Right.
Yeah.
But the S&P 500, they have a committee who sort of dictates.
Yeah. Do we know who's on that committee?
Yeah, I think if you looked it up, you could figure out who's on there. But their selection criteria aren't that transparent.
Oh.
Right? Which is a good thing, because it reduces this idea of speculation and sort of over-investing before going in. So anyways, a bunch of people invested in Tesla with that anticipation of it getting in there. And of course, it didn't happen.
Yeah.
They didn't make it in this year for unknown reasons. Probably just because I think the S&P 500 committee views their stock as a little too hyped up. And the fundamentals don't necessarily back up that stock price at the moment.
Yeah.
Which is, it's a subjective assessment. In any event, it didn't go in. So people who were speculating, didn't get that pop they were looking for.
Yeah.
Of course, if you're asking me personally, I think Tesla is still a strong long-term proposition. I wouldn't have said that a few years ago, but my opinion has changed, as it always does. So that's a very long-winded introduction to the concept of buying the dips. Right. And so what buying the dip means is you wait until
stocks not crash, but go below a certain threshold.
Exactly. They go below, whatever you think is reasonable.
Yeah.
and you buy in with the expectation that goes up.
You'll make a profit from
Right.
it. Mm-hmm.
And the reason this works is, or it should work in principle, is that we've discussed this already. The stock market's going up, right? We know it's going up,
Right.
but it doesn't go up in a straight line.
Yes.
It goes up in a kind of like jagged ups and downs.
Yeah, if you Google stock market and you'll see the S&P and the Nasdaq and Dow Jones, you'll see it's all very like up and down, up and down,
Yeah,
up and down, very
totally.
jagged.
Very jagged.
Yeah.
And what makes a huge difference in the shape of that graph, that chart, is your time frame.
Yes. Right.
And so depending,
that's a good
it
point.
tends to, if you zoom way in, it can smooth out. But if you zoom out, you see these huge fluctuations and really steep, dramatic curves.
Yeah.
So in any event, when you know that it's always going to go up, but it's not going up regularly, what people who buy the dip are trying to do is say, well, I know it's going to keep going up, but if I invest now,
When it's low.
well, let's start with the high.
Okay. Yeah.
Let's just say it's at sort of the average. If
okay.
there ever was an average,
Yeah.
right? Then if I invest now, I won't get as much money as if I waited for it to go down a little bit during one of those jagged things.
Yeah.
If I invested when it went down a little bit, then I would get both the benefit of that sort of constant increase. In addition, I get that little extra from it being artificially lower than it should be because of random short-term reasons. Right. So there is actually a metric that people use to assess what the average price should be
For a specific
indices.
Specific indice, yeah.
Or even broadly. So, for example, right now, a lot of people are, well, it's corrected since this happened, but a few weeks ago, the stock market hit all-time highs again.
Yeah.
And a lot of people are saying it's way overvalued, right?
Like inflated.
It's inflated.
Right.
But how do they calculate?
How can you assess that?
Right. How is it overvalued?
Right.
Based on what?
What metric are they using?
So one of the primary tools they use, and I should do a video about this, is what's called the PE ratio.
Oh, interesting.
Price to earnings ratio.
Okay.
Right? So what's the price of one share of their stock and how much money do they generate from that share, right? So how much revenue do they have versus the price of their stock? And that ratio tells you, is their stock price way above the amount of money they're making?
Right.
Or
below
is it
a certain
it's
threshold?
it's almost never gonna be below.
Okay.
Unless there's something really weird going on.
Yeah.
I can't think of an example, but maybe there is.
Yeah.
I'll let the stock experts
Bring
up
yeah.
the edge cases.
Yeah.
But your share price is always gonna be a little higher than the earnings.
Yeah.
At least a little bit.
Okay.
Because your share price reflects future growth, right? So the company's going to continue to get bigger. So if you just paid exactly what the company's making right now, you're basically saying that company's never going to grow.
Right.
So instead, by paying a little more, you're basically saying it's going to be bigger later, so I'm going to pay a little bit of premium to capture the growth.
Because you're investing in it, so to speak.
Exactly.
Yeah.
So that share price, that PE ratio, is just one way. Price to earnings is one way to measure where the market is. And I can't remember the specifics, but I think somewhere in like the 15 range is reasonable.
Okay.
Right. And recently it hit the 40 range, which means the share price was 40 times the amount of money that these companies were making.
That's
right.
Yeah.
So they're basically saying this company is going to be 40 times more valuable at some point in the future than the amount of money they're making now.
At present.
Which, if you think about it, that's a really bold claim.
Yeah.
It happens.
It could happen.
It does happen.
Yeah.
But it's a bold claim.
And how can you really say that with any, assertiveness, right? And certainty.
It's tough, right? You always want to bake in a premium, but you don't know how much.
Yeah.
So anyways, when that gets really high, the PE ratio, which it has been for the last couple of years, people say the market's overvalued.
Yeah.
And it's really hard as an individual investor to invest in the market when everyone's saying that it's overvalued.
Right. Yeah.
Right?
That is tricky.
Because it's like,
do you trust them? Do you trust your gut? Do you bet on humanity, which is what Greg's advice is from the other video?
Right.
Yeah.
Right. So when it's
What do you do?
overvalued, you're like, well, that means eventually it's going to rectify itself
Yeah.
and self-correct back to the actual price.
Right.
So you're saying, yeah, over a 10-year time frame, it's going to go up.
Mm-hmm.
But you're saying it's overvalued. That means, maybe in a 2-year time frame, it's going to go back down to average,
Mm-hmm.
which means if I invest now, it could go down and I'll lose money, right?
Right.
So buying the dip is this sort of short-term
Gains.
fear of fluctuation.
Right.
And so what people tend to do is say, okay, well, I have this money. I could put it in the market now, but I know...
Wait.
Or wait,
Yeah.
right? I could put it in the market now,
Mm-hmm.
but I know that the market's overvalued and it's going to go down soon.
Yeah.
So what I'm going to do is just wait.
Right.
I'm not going to put the money in yet.
Mm-hmm.
I'm going to wait until it goes down a bit, and then I'm going to put my money in.
Right. And what do you say to that?
Well, okay, that in principle works.
So then you're just hanging on to cash. You're
hanging on to cash.
pretty liquid, which in some cases that might be what you want to, the position you want to
be
in, right?
Sometimes it's nice to have cash, but if you have a lot of cash, it's losing value.
You're not putting your money to work, in other words.
Exactly. You're not putting it to work, right?
Yeah.
When cash sits in a bank, as we discussed in the lesson, you might get a small nominal amount of interest.
It's like cents that they...
Tiny. It's tiny. Yeah, it's fractions of percents. It's a tiny, tiny amount. I mean, I think the rate right now is like 0.3%, which is a very small number, right?
0.3.
Think about it. If you put $100 in, 1% of that would be $1, right? So 0.3%.
Like 3 cents, not even 3 cents. It's like
0.3% would be 30 cents.
30 cents.
Yeah, 30 cents on $100. You could do better things with that. You're certainly not going to retire on that.
Yeah, I mean you can't buy anything nowadays for 30
Yeah.
cents.
And meanwhile, you have inflation, which on average goes up in the U.S. by 2 to 3%. Right, each year.
Yeah.
So if you're earning only 3% interest, 0.3% interest on your bank account, and inflation's going up by, let's say, 3%, you're suddenly, 2.7% of your value of your cash is eroding each year.
Right.
So that's why we
say...
So
you're losing money, basically.
You're literally losing money.
In a way, right?
Because that dollar is worth less a year from now due to inflation. Things cost a little bit more than they did this year.
Right.
So that dollar can buy a little bit less.
Right.
So when you park your money in a bank, it just doesn't really gain much value. You do want some cash, like you said.
Right.
You want some to cover emergency
expenses
funds
and like
and
rent
just routine
and
expenses.
Yeah, like groceries. Like so, Greg had a great in one of the videos he put out talks about really defining like your budget so that you know how much cash you need on hand for things like incidentals, groceries, I don't know, whatever other expenses we have just by living, right? I used to joke around and say, in certain places, right, you're like basically paying for the air you breathe because certain places are more expensive than other places.
It feels
and it's
that
like
way.
Where, you feel like you're being charged just to take an in-breath.
That was New York City.
That's New York City. It's all, different cities around the world, but definitely New York is one of them.
Yeah. Hong Kong.
Hong Kong, for sure.
Yeah.
So, yeah, I mean, I think it's important, especially now, to think about, like, reevaluate budget and maybe with some flexibility, if you have flexibility, to kind of, like, maybe be able to take advantage of that. And if you're working, like, online, then maybe you don't have to, spend so much money for the air you breathe, so to speak, figuratively.
Yes, and that's another great topic.
Which you'll get to.
Which we'll get to.
Yeah. They're all so interconnected.
I know, they are.
It's hard
to
like not talk about it.
I know.
I want to ask you, you mentioned Warren Buffett in
Yes.
your previous lesson. What makes him, why is he touted as such a, like, know-it-all when
Well,
it
he
comes
knows how to put his money to work, right?
Right,
So
but why does it, when we think of, stock and investment, why does Warren Buffett come to mind?
So he knows how to put his money to work.
Yeah. But what does that mean? Exactly?
Yeah. So the cash we were just talking about, right? So if you hold on to cash, it loses value.
Right.
Warren Buffett knows this. And so what he does...
he knows it very well.
Yes. So what he does is, instead of hold on to cash, he invests it in companies that have long-term growth. And it's actually, his strategy is quite relevant to what we're discussing here, right? He's not trying to buy the dip. What he does is just looks for good deals in companies that have very long-term growth prospects.
Right.
Right. And so he's all about time in the market. So he basically spends a ton of
Time in the market as opposed to timing the market.
Yes,
right?
exactly.
It's 3 words. Time in, 4 words, the market.
Yeah. So he spends a ton of
yeah.
time researching these companies, understanding what their sort of long-term prospects are, what's the quality of the management.
Right.
Right.
And seeing if they have like, if they're gonna grow, like if they have,
are they gonna grow? How defensible is their product, right? Are they
right.
susceptible to competitors?
right.
You know, basically all the things that make for a good long-term healthy
Long-term,
company.
yeah.
Not the speculative, it doesn't even have a product yet, no
Yeah.
revenue, and I'm just gonna, hope that it earns a lot of money.
What was that VR thing where?
Oculus? No,
Was it
Magic
no,
Leap.
Magic Leap.
Yeah, billion.
They got a huge
billions of dollars.
valuation, multiple rounds.
Didn't even have a product, and they still
crazy.
exist, I believe. But it's, I mean,
I think they're getting phased out.
let's just say I wouldn't want to be in charge of their finances.
So
right now.
Buffett would not invest in something like that.
No, that's like the
right?
opposite
That's
of what he would
exactly
do.
the opposite.
He
yeah.
invests in things like Coca-Cola.
Right.
He invests in Apple.
These household names that we grew up with.
and,
right?
and some that you wouldn't even recognize, but they're just huge, like railway companies.
Yeah, sure, exactly. Things that from our
he has a lot of
grandparents'
energy.
generation, maybe.
Yeah. So what he does is he invests and then he just leaves it. And so he doesn't make very many transactions. And that's, as an individual investor, we want to do the same thing, right? Time the market dips. So going back to our example, right?
Yeah.
We were saying, okay, so you're holding on this cash. The cash is losing value over time.
Being like Scrooge, counting it out.
And so the cash is losing value. And you're like, okay, so the dip's coming. The dip's coming. I'm going to wait until the dip comes.
Yeah.
And then I'm going to put my cash in.
Right. And then what happens?
But in the meantime, you're waiting. Right. And the market keeps going up and up and up.
So
right?
no dip.
And your rule is you're waiting for a 2% dip. Let's say.
Okay. Right. You've set that number somehow.
Set that number. That way, if you buy the 2% dip and it pops back up to its usual price, you've baked in an extra 2%.
Okay. So a little cushion.
A little cushion.
Yeah. Okay.
The problem is it doesn't dip 2% until it already grows like 7 or 8%. Right? So it's grown now.
Meanwhile, you're hoarding this money.
Yeah. So it's grown 8%. Then it dips 2%. You're like, oh yeah, get in there. So you dump your money in.
And then it crashes.
But the thing is, it grew 8%.
Right.
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 So when it grew from the baseline to 8% more, the money you could have made in the stock market, you didn't.
Right.
Right.
Because the time in the market was not there.
Because your money wasn't in the market.
In the market.
You didn't benefit from that growth.
Right. Even if it was like a few cents or a few dollars.
Yeah. It didn't benefit from the growth. It was in the bank, and it was actually losing money because of inflation. Yeah. So you doubly lost. You lost the opportunity cost of being in the market.
Yep.
And then you also lost the cost of inflation because it's sitting in cash.
Yeah.
Right. So you doubly lose. So yes, you bought the dip, but it wasn't as big a dip as you were hoping.
Right.
And you ended up losing. And the reason why this happens is because the market goes up more.
It fluctuates.
Well, it fluctuates, definitely. Yeah. And that's what tricks people. But it goes up more than it goes down.
That's right. Yeah, you mentioned that in one of your lessons.
It's kind of like playing roulette, right? And you're betting on red or black. And let's just say instead of there being an even number of red pieces and an even number of black pieces, so the chances of landing on one or the other is equal, instead, let's say there were half as many black pieces as there were red pieces. Right. Right? And if that's the case, what's more likely to happen? Is it going to land on black or is it going to land on red? There's half as many black as there are red. If you throw a ball on that table, land on red, right? Because there's twice as much. More, yeah. And it's the same reason in the market, right? If you're going to bet on one of two things, it going up or going down.
Bet on it going up.
You're better off betting on it going up because on average it goes up more than it goes down.
Yeah, that's a good tip.
And that's why buying the dip doesn't work.
Right.
And it's why instead time the market, like we're talking about Warren Buffett, right? He puts his money in and just lets it grow. If he's constantly taking his money out, the companies that he invests in, an interesting one recently, he invested in IBM. And IBM's been down for a while now.
Okay,
And it's
interesting.
only gotten worse. It had a huge success story years ago. And I think he may have had an original position there years ago. But it was this
Okay.
beautiful stock that went up, paid great dividends for a long time, and then just tanked as it sort of lost relevance. Right? IBM computers, no one buys IBM computers anymore.
Aren't those the ThinkPad?
So they
Is that-
used to be. Yeah,
Oh.
yeah. And that was spun off.
Oh.
Right? So IBM doesn't really have a computer division anymore.
Oh.
They're really just a services company.
Okay.
But
yeah.
they do have one ace up their sleeve.
Okay.
And they used to be, and they continue to be servers. You know, they provide sort of backbone infrastructure.
It's still a household name, right?
It is, but they have one trick up their sleeve.
Their saving grace.
Yeah,
What
which
is it?
is Watson. Have you heard of Watson?
I'm thinking of there's like a department store in like England and Turkey, but it can't be that.
Well,
What
it's
is it?
named Watson. I believe it's named after the Watson and Crick. I think they were They discovered DNA.
Yeah. Oh.
Watson is their supercomputer.
Oh yeah, you've mentioned this.
Yeah, yeah.
Okay.
Or maybe it's Watson. Is it Sherlock? Is Sherlock Holmes? Is Watson his
sidekick? Yeah.
It could also be that. But the point is, they had this supercomputer that's developing a bunch of AI
Yeah.
stuff.
Is this the one where they're talking to each other? The computers, they're talking in zeros and ones. It could be that. I don't know. It was a couple years ago.
But maybe.
Yeah.
Maybe. Yeah,
Right.
they do a lot
Yeah.
of stunts like that,
Yeah.
publicity stunts. But they have Watson.
Right.
And so right now, Watson's not really doing anything.
It might not be relevant right now.
Yeah, it's not in the news much.
Yeah.
You don't really hear about it. But his thinking is this is basically one of his few technology plays. And he believes that IBM stock is undervalued relative to the quality of their management, the quality of their assets,
Okay.
and that Watson over time is going to generate a long-term value for him, right? And so he's made that investment. Right now, everyone's saying that was a bad investment because it's gone down for years. He invested years ago, and it keeps going down, down. But that's not the way Buffett works. Buffett doesn't say, "Oh, you've gone down for a couple of years. I'm taking it out." He leaves it in there,
Yeah, he's
unless
all
there's
about-
really a warning sign.
He's more about the marathon, the time in the market.
all about the marathon,
Yeah,
exactly.
it's a marathon, not a sprint.
Yes,
And that translates to other industries, other things that people might be doing, right?
it does. That's the beauty of this concept. It's not just finance.
Yeah.
Like, can you think of another example where time in the market outside of, outside of the stock market,
Yeah.
where time in the market actually generates better returns?
Yeah, for sure. I mean, YouTube, right?
Yeah, YouTube's a great example.
Being on the creator side of it.
You're on the creator
So,
side, right? It's
uploading content,
right.
getting crickets for a while, right? Been there, done that.
Yes.
And just, waiting that out, but not saying, okay, well, I'm going to stop this, taking out your money, so to speak, but constantly keep, investing in it and just knowing that over time, with consistency, you will see returns.
Yeah, and you nailed it. The key word here is consistency.
Yeah, it's like the magic word for a lot of things in life, right?
Yeah, and time in the market is fundamentally based on this idea of consistency.
Yeah.
And whether that's in investing, that's leaving your money in there, and then maybe regularly investing on a dollar cost averaging basis, right? Or it can be, again, in YouTube, constantly uploading videos, like continuing to put out content, even when you're not feeling up to the task.
Or if no one
do it
seems to be
anyways.
watching,
Yeah.
no one seems to be liking it, no one seems to be engaging with it, they will. One day they will.
Yeah, eventually it gets
happens.
picked up. Authors do the same thing, right? Authors, they need to
Yeah,
keep writing,
that's
right?
right.
You need to stay warm.
Yeah.
If you're applying to jobs, right, and you're looking for a job, you keep applying, right? You don't give up after the first few rejections. You
Yeah.
keep going.
Keep doing it.
It's time in the market. You put yourself out there long enough, someone's going to pick you up.
Auditions, right? Another example, you look at these
Auditions.
actors, it's like there are so many actors, just like it's overflowing. The industry is teeming with aspiring actors, and there are only a few at the, the top, right? The ones that you know of in Hollywood. And when they talk about their success story, there's always this one breakout video or movie
Totally.
or television series that they've been a part of or streaming series. And just that they got their
It changes
lucky
their lives.
break, it changes their lives. And you ask them, or they tell you how many, I don't personally ask them, but you know what I mean.
Yeah.
Collectively, society does as a whole in interviews. They say, okay, so how many, auditions have you been to? They're like, well, I've done 1,000 of them, got rejected from 999 of them, got that one.
Just takes one.
And it just takes one.
And that's a really important lesson.
Brutal though, right?
Oh, brutal.
Yeah.
And it's tough. And that's why a lot of people don't do this. It's why most people don't do this, right? It's tough. It's can be boring. It can be discouraging.
Tedious.
It can be tedious.
Yeah.
We're so geared toward instant gratification.
Yeah.
And the reality is, for a lot of things, there are ways to tilt the odds in your favor.
Yeah.
But for a lot of things, including the stock market, including the stuff that we commit a lot of time to, our occupations, so much of it really just has to do with time in the market, showing up, right? Being there, and putting yourself out there is the real secret to success, because most people will give up pretty quickly.
Yeah.
And when you persist, when you persevere, you ultimately
You've already surpassed those other people.
Yeah, you've put yourself in rarefied air.
Yep.
And eventually the dividends, the compound interest starts to come in, and it starts slow, but exponential growth gets pretty impressive once the numbers get even a little bit bigger. So.
Yeah, which is exciting, right?
Yeah.
So thinking about that and being smart about where you put your resources, your time, your energy.
Being patient.
Yeah.
Is a good way to go.
All good life lessons.
Yeah. So there's who knew that investing in stocks could apply to your entire life, but
I know.
That's the
well, because it's again, I love that analogy you made, is betting on humanity, right? It's having faith that, whatever it is in that current moment, it might not be, sunshine and roses, but over time there will be, the sun will come out.
When you look at history, we've accomplished some pretty incredible things.
Yeah.
And human life has gotten a lot better.
Yeah, even if it might not feel like that.
Doesn't always feel like
that.
It's like when you look at the overall sort of picture. Yeah, that's the case.
Optimism. Yeah.
So anyways, that's what I guess what we'll cover for today.
Yeah, it's a lot.
If you have any insights or questions or sort of things you would like to add to this conversation, just do that in the comments. That's what they're there for. If you get the chance, take a look at our upcoming lives and join us live.
Yeah.
Because we love interacting with you guys.
That's right. And it's a great opportunity to ask questions and get them answered on the spot.
Exactly.
Q&A.
Yeah. So anyways, great seeing you guys, and hope you enjoy this. And
happy wealth staking.
Happy wealth staking. Catch you next time.